Hello, I'd like to talk a little bit about types of commercial loans. So there are numerous banks and CMBS lenders and originators that are providing different types of commercial loans, and I wanted to just name them here today so you can get a broad understanding of generally what they're about. So let's start with, in alphabetical order, an agency loan. The agencies or the GSEs are in our business, and for the most part, the bulk of our business, we're using Fannie Mae and Freddie Mac. And Fannie Mae and Freddie Mac are two quasi-governmental agencies that are providing financing for the housing stock in the country, and they're doing obviously single-family residential. They're guaranteeing single-family residential mortgages as well as multifamily. So Fannie Mae and Freddie are the two large organizations that are doing that. Now, you just don't submit a loan to those agencies. You have to go through essentially a licensed originator that they're able to underwrite the loan according to Fannie and Freddie standards. They'll make $100 million, $200 million worth of loan and turn around and sell those to those agencies. But they have all of the credit underwriting capabilities and credit decisioning in-house. So you'd have to go through someone like a Walker Dunlop or a Greystone to be able to access the Fannie and Freddie agency loans. Another type of loan is a bridge loan. Oh, by the way, just the agency loans are generally non-recourse. They're generally for longer term investors and stabilized assets. You have to have 85 to 90% occupancy before they would consider funding an agency loan. So it's generally for a client who has a stable asset. They want long-term non-recourse money at very competitive rates. That's where an agency loan is competitive. A bridge loan is a loan that will bridge you from where the property is now, which is usually a condition that is not ideal, to where you want to get that property. So, for example, if you wanted an agency loan, it wouldn't be in your best interest to get a long-term, for example, 10-year loan on a property that you could improve within a year and then raise the rent. You probably want to hold off on putting that permanent agency loan on it. You want to wait until you have that property cleaned up, fixed up, and you can raise the rent, and you'll get more proceeds that way. So you might do that with a bridge loan, or a rehab loan, it's sometimes called. It's not a construction loan because a bridge loan, you're inferring that if it's a bridge loan that there's a structure there and it just needs some cosmetics or it might need some heavier lifting. The bridge loan rates, depending on the location and the experience of the sponsor and the condition of the property, bridge loan rates can be as low as 4% or as high as 10%. That might be a hard money bridge loan. Also, bridge loans are sometimes used in the hard money world and the hard money vernacular to do a quick closing. So you may not have the time to go to a lender to do complete underwriting. You have to act quickly, and that's where a bridge loan can come in. So there's a loan that could be a bridge loan, it could be an agency loan, but it's more of the vernacular of the motivation of the borrower. But I decided to include it here, and it's called a cash out refi. And the reason why I wanted to include it here is because the agency lenders or the bridge lenders or the CMBS lenders, they generally will do cash out refis, but they want to know what the sponsor is going to be doing with the money, and so on. So it's good to understand that if you're talking with a lender and a borrower wants more money than the senior debt currently on the property that you're going to pay off. For instance, let's say you have a $2 million loan currently on a property and the property can support after 2 or 3 or 4 or 5 years of operating and improving the condition of the property, it can support a $3 million loan. Well, then that's called a cash out refi. And when you approach your lenders, you should let them know that up front. A cash in refi is just the opposite. You might have a situation where a very conservative borrower wants to pay his loan down, or on the other hand, maybe the value of the property has come down and you have to cut a check to refinance the property. So I recently had a call from a New York City investor who had a $20 million loan on a property. The value of the property decreased because his leases and some other complicating factors came into play. And the value of his property came down. The bank re-underwrote the property and decided that they really should have not a $20 million loan on that property, but a $17 million loan on that property. And embedded in the documents was their ability to request payoff of the $20 million. And so when we provided him with our opinion after some brief market discovery, after analyzing his numbers, well, it turned out that the largest loan we could get on that property would be about $17 million. So he would have to stroke a check for $3 million and do a cash-in refi. That is generally in a declining market, you will see cash-in refis. Construction loan, it is a first mortgage that's used to, the proceeds are used to build a building. Generally, construction loans are not funded 100% day one. They're funded over time using construction draws. Not every lender does construction loans. The lender has to be administratively structured so that they can review receipts, review plans, review the process and the progress of the building, and distribute funds accordingly. So a construction loan is done by not every bank out there, and there are construction loans that are non-recourse. Most banks' construction loans are recourse, and they are something that if you're any good mortgage originator should be doing a few of these a year, because there's always a deadline. A developer has his permits that the clock is ticking. He needs to get something going. So construction loans are great from an origination standpoint to work on. A CMBS loan. CMBS stands for Commercial Mortgage-Backed Securities. You might hear people refer to them also as conduit loans. So a CMBS loan is where a Wall Street bank is originating loans in order to take, if it's large enough, that single loan, or generally and ordinarily it's a pool of loans. Let's say it's a $250 million pool of loans. There might be 25 properties or 50 properties in that pool. They will then turn around and make those streams of income into bonds, and they will sell the mortgage to institutions as a bond investment from the institution's perspective. I'm not going to get into how they slice and dice the different yield categories, but you ought to know that it's called tranches. So they provide, for example, the most secure AAA income stream. Some investors prefer that. Other investors are willing to take on more risk, and they'll buy not the AAA income stream, but the lower grade income streams because the yields are higher. Not everyone can do conduit or CMBS loans. The ability for them to act as sort of investment bankers is really key. And so some of the larger banks or larger institutions have the ability to do this. So CMBS loans are, the advantages are they're generally non-recourse, generally 10-year terms, the rates are competitive, and the investment banks are hungry for them. They're looking for reasons to do them. That's how they make their fees, by packaging these loans and then securitizing them. So it's always a good relationship and a good conversation I have with my conduit and CMBS lenders. I enjoy dealing with them. A fix and flip loan, you'll hear that mostly in the single family residential markets. You don't see it much or hear that phrase much in the commercial real estate market. You will hear the bridge loan concept. Fix and flips, pretty straightforward. Buy a property with borrowed money, or buy it all cash and get a fix and flip loan to clean it up, fix it up, and then sell it within a year to flip it out. There is another type of nomenclature called a rate and term refi, and like a cash out, you should let your lender know up front. Lenders like rate and term refis because they're not providing cash out. What a rate and term refi means is you're providing the borrower with the same amount of proceeds in the new loan as exists on the current balance of the old loan. So let's say somebody wants a $2 million new loan. They're really just looking for a longer term and a lower rate. It's a rate and term refi. They don't want any cash out. They're just looking for a lower rate or better terms. Or if they're, for example, fixed rate, their 5-year or 7-year or 10-year fixed rate loan has run its course, and now they're in the adjustable period. The prepay burned off. They want to go into the market and get another fixed rate loan. They don't want to be subject to the vagaries of the market and have an adjustable loan on their property. So that's a rate and term refi. SBA loans. I think everybody in this business kind of knows what an SBA loan is. There are two types, a 504 and a 7A. And SBA loans are great if you're an owner looking to buy your building or you have a franchise. I personally don't do a lot of SBA loans. Actually, I've never done one SBA loan. I do have people on my staff that have. I started in investment real estate and sort of have stayed focused on that. But SBA loans are something you can easily learn more about on the SBA website. There are numerous lenders that will do SBA loans. There are numerous non-lenders that will also do non-SBA loans for you. That will do SBA loans for you. And sometimes they're a little hungrier maybe than a lender, and are quicker than a regulated institution. But I would encourage you to learn more about the SBA loans on the SBA's site, because it really they do a great job of outlining the differences between the 504 and the 7A program. A takeout loan, you'll hear the term takeout loan. If you have a construction loan that is coming due and the building has been completed, or you have a bridge loan that's coming due and the rehab has been completed, you want to remove that construction or that bridge loan. You want to take it out with a permanent loan. So a takeout loan is a motivation. It's called a takeout loan, or it could be called a permanent loan to pay off the construction or the bridge loan, and then you're looking for a permanent loan, or sometimes called a term loan, where again you're looking to put a 5, 7, or 10-year loan on that property now that it's complete and hopefully stabilized. So those are the types of loans. Some of the vocabulary that's used when you're talking with lenders. There's also a download here. You can read through it, and obviously you can Google those terms on your own and take a deeper dive. But thank you very much, and we'll see you on the next lesson.